So, hello everyone. Today's area of discussion is a very hot topic in the trading industry, derivatives, and I'm sure a lot of you would have come to watch the video seeing the buzzword. And why I thought this was important to be discussed is because, firstly, we talked about the conventional ways of investing like stocks, mutual funds, bonds, or whatever the rules in finance, how to invest, but somehow we missed to talk about this very crucial area, which I think a lot of people, because of word of mouth, are getting stuck. And the whole idea behind making this video is to lay down a simple understanding framework for derivatives to these kind of people who actually want to make money through investing in derivatives, which has slightly now become riskier because of lack of knowledge. So, without further ado, let's try to meet the purpose of the video and go ahead. So, we'll talk about what derivative is. So, we all are aware that there are conventional ways of investing like stocks, like mutual funds and bonds and all. So a derivative is also an investment vehicle. It's just that we are not investing into a stock, bond, or a mutual fund. We are investing into a financial instrument whose value is being derived. So that is how the word derivatives comes, because it is deriving its value from another financial instrument. And it may not be just a financial instrument, it can be a commodity as well, which is again a financial instrument in a way, or any object or anything it can be. But let's just, for simplicity purpose, let us just assume that it derives its value from another financial instrument. So such kind of a financial instrument is called derivative. So to give you an example, let's say Cristiano Ronaldo, he's a very popular footballer. He signed a football. I mean, normal footballs that we get. A normal price for football, if it is 500 rupees, if Cristiano Ronaldo signs that particular football, would the price of that particular football be the same? Or obviously it will become more valuable. It may not be valuable to people who don't like Cristiano Ronaldo or who are not football fans, but it will definitely be more valuable to people who are Cristiano Ronaldo fans or who follow football and all. So just by Cristiano Ronaldo signing the football, the value becomes, let's say, 10,000. So this football is the derivative instrument, and Cristiano Ronaldo signature is the underlying. Underlying is the particular financial instrument or the object from which the derivative derives its value. So the football is the derivative in this particular case, and Cristiano Ronaldo's signature from which its value is fluctuating is the underlying. So this is primarily an example of a derivative which derives its value from an underlying. And we may have, just like a signature of Cristiano Ronaldo, we can have different financial instruments like stocks, bonds, commodities, currencies, which you can see on the screen. Now, this is the underlying part. We'll come to what derivatives are, what kind of instruments are composed under derivatives. So, majorly, there are four types of derivatives. We have futures, we have forwards, we have options, and we have swaps. For this particular video, we'll only discuss the first three, and we'll not try to, dig deep into swaps, because it's again a very big discussion and I was planning to make another video on it. But just for simplicity and the time constraint thing, we'll try to stick to the first three ones. Now let's just come to forwards. Forwards, I'll try to give you an example also so that for you'll understand better. Let's say, for example, you are the owner of an airline company. Now, you feel that the price of the fuel which is used to run the aircraft will increase in 2 months. Right now, it is 10,000 per liter or something. In 2 months' time, you feel that it will be 13,000 rupees per liter. So, you are scared of the fuel price rising. What you are going to do is you'll go to the, let's say, for example, the particular organization which will supply you with the fuel, that see, can we do an arrangement that we'll agree today itself that after 3 months, I'll buy this fuel at 11,500 rupees per liter. This you tell him because you feel that the price is going to rise, so you want to lock in a deal today so that after 3 months you don't have to pay that extra 1,500 and you're ready to pay that 1,500 rupees right now from 10,000 to 11,500. But you feel that if it's 13,000, it will become more costlier and maybe it can be more than 13,000 also. So what you're trying to do is you're trying to lock in this 11,500 today, and after 3 months, this particular person will give you the fuel and you have to pay the requisite amount. And so this will be like a delivery sort of arrangement. So this kind of an arrangement where you are actually agreeing the price to be paid in the future for a particular thing or any kind of object that you want or a goods you want or whatever is called a forward contract. Now forwards and futures are mostly similar. It's just that there is no regulatory authority governing forwards. So whether or not the fuel company would give you the fuel at a price of 11,500 after 3 months will not be insured by any regulatory authority. So this is a drawback of forwards for which we have another derivative. So forwards is a derivative instrument because so when you are buying the fuel, right? So when you're buying the fuel at a fixed price, I mean a locked in price of 11,500, this this forwards that you're buying is the derivative instrument and the underlying is the fuel that you are actually purchasing from the fuel company after 3 years, after 3 months or 2 months, whatever. Now coming back to what I was discussing, a futures contract is similar to a forwards contract. It is just that here you have a proper regulatory authority in the form of an exchange, national stock exchange. We have just like a normal stock market, which will actually ensure that the delivery of that particular product or commodity is actually happening at the price you have agreed with the product provider or whoever whatsoever. So if we take the example of a share, which is a very basic example, let's say the share of Reliance Limited. So if the price of one Reliance share today is around 1,400 or 1,500 rupees, I can actually buy futures of those Reliance shares at a fixed price. So generally, what happens is there are three types of tenures. So one is the same month in which you are going to buy the futures or the forwards. One is 1 month later, and the other is 2 months later. So that is how it generally is. So let's say, for example, today is July, and the month going on is July. You can buy a futures for end of July. You can buy a futures for end of August. You can buy a futures for end of September for Reliance shares. So you feel that the price of Reliance shares are going to rise in the month of August, right? So now it is around 1,500 rupees. In the month of August, you anticipate it to be 1,550 rupees. So what you are going to do is you buy a futures for end of August, wherein the price you agree to buy the Reliance share is 1,522 rupees. So that when after 2 months you're anticipated in after that, I mean when you arrive at end of August, when you know or when actually the price of the Reliance shares becomes 1,550, you have already locked in the price of 1,522 and you can purchase the Reliance shares at 1,522. So you then make, if you would have not bought the futures, then you would have, and you would want to purchase it at the end of 2 years, you would have to pay 28 rupees extra, 1,550 minus 1,522. So this is the whole objective, that when you feel that the price of a commodity or an underlying is going to increase, that underlying can be share or other can be the fuel of that particular airline, you actually lock in a price today and you make the transaction. Now, before coming to what options are, let me tell you what is the drawback of futures and forwards. If you lock in a deal with the counterparty, in our let us take the example of the previous example that we took, the airline company, we have entered into an arrangement with the fuel provider. After 2 months, you have to compulsorily take the fuel at the pre-agreed price. The price which you have locked in, you have to compulsorily buy the fuel at that particular price. And if it, so that is referred to as a physical delivery of the particular commodity or the underlying. Now, when you have to have to compulsorily take the physical delivery of that particular commodity, in our case, the fuel, it can be so that your prediction goes wrong. Suppose it is 10,000 rupees per liter right now. You anticipated it will be 13,000 after 2 months. So you entered 11,500. I'll lock in a price right now. But what if the price has not gone up to 13,000 and it's 10,800? So you have to compulsorily take the fuel at a price of 11,500, which was locked in by you, when you could have actually avoided the futures and could have bought it at 10,800 after 2 months. So then, because this compulsory delivery comes into the picture in case of futures and forwards, there was another need for another derivative instrument which could help us exploit the derivatives in a better way, and that is how options came into the picture. Now, what are options? See, English is a very funny language. Most of the things, the name only would tell you that what is the nature of this particular kind of instrument. So this is option. Option means something that you can do or you cannot do, right? I mean, we generally talk in English, right? I have the option of this, I have the option of that. So let us take that example only of that particular airline company. If I am standing today and the price of fuel is 10,000 rupees per liter, I feel that after 2 months it is going to be 13,000. So I will buy option on that particular fuels. Again, option I'm buying. So this option is a derivative, but the underlying remains the fuel. So I will buy an option at a price of, let's say, 30 rupees or 40 rupees per liter of fuel, that I would be able to buy the fuel at 11,500 after 2 months. I have an option. I don't have to mandatorily buy the fuel in, like in the case of futures or forwards. Forwards are not, I mean, regulated. Futures are regulated because they are traded in the stock exchange. So options, you have the option. I mean, you can also reject the option. So in case you are buying the option of purchasing the fuel at 11,500 after 2 months, and the price becomes 13,000 after 2 months, so it will be a profitable option for you, because you would immediately exercise the option once the price increases, because you have already agreed a predetermined price which is lesser than the actual prevailing price after 2 months. So you're saving on the 1,500 rupees per liter, and I mean the 1,500 rupees you're saving, and you would have to pay a premium for the option you're purchasing, which is the price of the option. It can be 30 rupees per liter or 40 rupees per liter, whatever. So automatically the 1,500 rupees per liter that you're saving minus 30 rupees per liter option price that you're paying. So ultimately your profit is 1470 per liter. So when you buy a option and the price increases from the price that you have pre-agreed, then you are at a profitable situation. So there are two types of options. This particular example that we took was call option, which means right to buy. I have a right to buy fuel at 11,500 after 2 months from where I'm standing right now. A different kind of option is put option. Put option is right to sell. I mean, just the opposite. So, I mean, you can take another example. A seller of a particular product, let's say uh, agricultural produce, maybe rice, wheat, whatever, they feel that there will be excessive supply of that particular product and the prices will get decreased. So he will be, and he has grown a lot of the particular agricultural commodity. So he just wants to dispose it off at a price which is fair and which is profitable for him. So he can definitely agree the put option, which is right to sell at a particular price. Just the reverse case of what we discussed in the fuel case study. So if today it is 200 rupees per kg, for example, the particular person feels, the farmer or the person who's actually dealing with this agriculture commodity feels that after 2 months the price will be 180. So what he will do is he will agree a contract or predetermine lock in a price with the customer or whosoever, the wholesaler or whatever he's giving, that I will sell this to you at 195 rupees after 2 months. So now, if the price is lesser than what he's already predetermined, then he's at a gain situation because otherwise he would have sold it at a loss of 180. Now he can sell it at 195, which he had locked in. Again, he would have to pay a premium for it. Let's say he paid 7 rupees per kg. So his ultimately it's costing him 188. I mean, he would be able to sell, he's selling at 195 and then he's paid a premium of 7. So 188 is actually his the net selling price. In contrary to the 180 price that would have been after 2 months. So he's actually making 8 rupees per kg more by, I mean, as a result of purchasing this put option. Call means calling, right to buy. If I buy and you just see the hand movement, and put means putting something. Sell, right to sell. Now, when I'm buying a call option, what happens is the technical term is when I'm buying a call option, I have a right to buy. I have a right to buy, and or and the counterparty has an obligation to sell. So if I have locked in the price and now the price increases, I don't want to buy it at a higher price. I will only buy it at a locked in price. So I have an option to exercise that particular arrangement. But if I exercise the option, the counterparty cannot say that I also have an option. No, that person has to sell. So that is where we say obligation to sell. And similar is the scenario for somebody who's selling who's buying a put option, where that particular person has the option to sell, and the counterparty has, because he's locked in the price, or the option buyer, the put option buyer has already fixed in the price. The counterparty has an obligation to buy, and for this they have, what they're trying to do is, so actually what I'm trying to say is the disadvantage that was there in futures or forwards. I mean, forwards, it's not traded, so let's not talk about it. we'll, Futures and forwards are mostly similar, we talked about it. So the disadvantage of futures is being covered by options. But I would also want to practically demonstrate it to you, because I don't know how theoretically the discussion would have helped you. So let's just practically try to understand how this calculations would work in the best interest of all of us. So I'm just trying to open Moneycontrol. I'll search for Reliance Industries. One more thing, the futures, forwards, options, we cannot just buy for one share, or let's say, for example, 1 liter of the fuel or anything. It has to be at least for the particular lot size, which is already agreed in the exchange for each and every company. If I talk about shares, so in case of shares, you would find the lot size to be 1,000. Just a second. Yeah. So lot size would be 1,000. So minimum you have to buy that option or the forwards or the futures for that full lot size. Generally, the value comes to around 3 lakhs, 4 lakhs. So it's a big amount of money that you're dealing with, and you need to have high margin. Generally, you will find people taking high amount of debt to leverage on this particular transaction, and that is exactly where they face the risk because they take money on loan at a very high interest. And how can this be detrimental or more risky to them? I'll try to explain that through a mathematical example. Before that, let's just talk about this particular share, Reliance Industries Limited, right? The price is 14.95. Let's talk about the futures first. You will only find futures and options because forwards are not traded in the stock exchange. So you'll find futures. Today we are on standing on 13th of July. Here you would see three dates. 31st of July, the end of this particular month, as we discussed. We have 28th of August and we have 30th of September. This is next month and this is next to next month, right? So if I just select 20th August, you would see that the price today of Reliance is 14.95. So the market expects that next month end the price would be around 1503. That is how the pricing of futures has been set. Now, if I feel that the price is going to be more than 1503 at the end of August, then I will buy this particular future, right? But then I have to take a compulsory delivery of those amount of Reliance Industry shares for which I'm buying the futures. If I buy two lots, I have to take if 1,000 shares in one lot, I have to buy 2,000 shares at the pre-agreed price. So I will buy futures for 1,503 rupees, futures ending August. And then if the price is 1,550, then I'm at a gain. And if it is less than 1503, I'm at loss. Similarly, we can talk about options. Here you can see a relatively lower price, 23. So because this is the price of the option to buy or the option to sell. So again, let's just take the example of August. You can see here two drop down C and P. C means call option and P means put option. C, right to buy and right to sell. So 28th August 2025, if you want to buy if you're thinking that the price of Reliance shares will be 1600, right? So maybe you will exercise the option to buy it at 1550. So at the end of August, you have the option to buy the Reliance shares at 1550, but for this you have to pay 20 rupees per share premium to buy the call option. And if you go higher and higher, so this is, let me just share it with you. If you say that I have the right to buy at 1700 at the end of August, the price of the call option is very low. Reason being, the price is 1495 right now, and you are opting to buy it at 1700, which is obviously much higher than the expectations of the market. So if you're saying 1700, that means you feel that the price is going to be 1800, and I am taking this risk because I have to pay a lower premium amount of 2.60. So my profit will be higher. But in case you buy it at 1700 and the price is much below it, you can be at a very detrimental situation. I'll try to explain you mathematically how this is going to work. So let's just try to mathematically understand. So let's say, for example, the share price is 1500 as we saw, and the lot size for that one particular, let's just talk about options for now. The lot size is 1,000 shares, right? 1 month futures price is 1545. That means you have the right to buy 1,000 shares of Reliance at 1545 per share after 1 month. When will you buy this? And the option price is, so let's talk about options. 1 month option, call option. You have the right to buy I mean, one particular share of Reliance at, let's say, 23 rupees. at the end of 1 month, which is August end, at 15:45. Now, there can be two scenarios. This is a call option. That means it is a right to buy it at 15:45, and you will be only profitable if the price is going higher, because you will only be profitable if you have pre-agreed to buy it at a lower price than what it is actually prevailing at that point of time. So price after 1 month is, let's say for example, 1625. So ultimately, if you see, your profit is, you would have to pay 1625 if you would have not have bought the option right now. But so 1625 you would have had to buy it at 1625, but you had bought the call option to buy it at 15:45. So you are making this much amount of profit. Let's say for example you bought for one lot, this 1,000 shares, right? So this is around 80 into 1,000 is 80,000, right? But you also paid a premium of 23 rupees for this 1,000 shares, for 23,000. So your overall profit is coming to 57. And also just to mention, since futures and options are traded in the stock market, you can also sell these futures or options, the derivative instrument itself. So let's say, for example, there are news, right, about a particular stock. Reliance Industries is going to this. They're trying to acquire this company. Let's say, for example. So with this, the share price is definitely going to move. And in the initial discussion only, we mentioned that the derivatives derives its value from the underlying. So if the share price fluctuates, the value of the futures or the options would also fluctuate. It being a derivative, so you can also sell these futures. You bought 1 month futures at 15:20 right now, and it is trading at 15:40 after that news. You can sell it, right? So this is a very ideal situation. Now let's just try to change the scenario a little, where the probability of the risk comes into the picture. So you did the same thing, but price after 1 month is around, let's just take 14:20. So you have bought a call option. You have the option to buy. You don't have an obligation to buy. You have an option to buy. The counterparty has an obligation to sell, but you have an option to buy. So tell me something. If you have bought the call option at 15:45 and the price after 1 month is 14:20, will you exercise the option? You will not, because I will buy at 14:20 only then. Yeah, but my 23,000 loss is there because I paid a premium of 23 rupees for the lot size of 1,000 to buy that option, because I had that uncertainty. So my 23,000 loss is definitely there. This is a loss. Now let's say, for example, we take the example of a futures. Let's just take the same example. Share price is 1,500, lot size is 1,000, 1 month futures option. 1 month futures is 1622. The 1620 price after 1 month is 1327 or 1325. You would remember futures is an obligation. It is not an option. And that was the drawback because of which options are more favorable at times. So you have to compulsorily buy the 1,000 shares at a price of 1320, at the price of 1620, for which you had locked in the price, for which you could have bought it at 1325 if you would have not exercised the futures option. So now you are at a loss of, which would be around 305, 305, 3,05,000 loss. There can be scenarios like these as well. And generally, you would see that futures and options have the option size is a lot size is so designed that you have to minimum make an investment of 3 lakhs or 4 lakhs, and that is generally not available for a normal middle class or somebody who's not a very high net worth individual or a very big portfolio investor. So what they do is just because of greed, they try to borrow that money from the market at a very high interest, expecting that if I'm paying 18% interest, I would be able to make at least 28% return from futures and options. But what if the particular situation is reverse? Because market is volatile, right? What if that particular situation gets reversed and you actually have to pay from your pocket both the loan interest as well as the loss you have to bear? That is something which is a very bad way of leveraging. So I think the whole idea behind derivatives is it is a sort of gamble, right? It is gambling in a way. It is speculation. There are, I mean, practically, I would not want to talk about my experiences, but it has been both ways. Whenever I've been, trading in derivatives, there have been cases where I have faced losses. There have been cases where I've made very good profits, and then you again and again want to do it, just like how gambling is, right? So it is very important that knowing the basics, now you would be in a situation to decide whether or not you want to step into the shoes of being a derivative trader. Though this is a very short and crisp way of explaining derivatives. Derivatives itself a very big subject altogether, and there are subcategories and all these derivatives. Again, swaps we did not talk about maybe because there are swaptions, there are different kind of options. We just talked about call put. We There are different kind of options and so on. But just this is a brief idea on how the trading happens on derivatives, and it is very important that our hard-earned money is invested wisely, and the regret thing should not be there that I invested it without any knowledge or without the consequences, because if that happens there is no worse feeling than that. So we should be invest wisely. And one more thing which I would like to mention is that the options can be looked upon as something to take advantage of the situation you are afraid of. That is how I have understood options throughout my life, and it will be very easy for you if you understand it that. So if we go to the example of that particular airline company, what was the airline company owner trying to do? He was trying to take the advantage of the situation he was afraid of. So he was afraid of the fuel prices going up. So what he did was either he bought a futures or he bought a call option, because he locked in a price right now so that he does not have to bear with the lower price prevailing in the market after 1 or 2 months. So it is nothing but when you are afraid of something, you take advantage of it through this particular features and options or derivatives. Similar example of that agricultural produce seller, where he was afraid of the price of its commodities going down. So what he did was how he tried to take advantage of the situation. He maybe bought a put option, right, to sell at a fixed amount of price. I mean, obviously the premium paid and everything is there, but he tried to take the advantage of the situation by he was afraid of the prices going down. But immediately, so derivatives are nothing but a way of hedging. Hedging is when you're trying to insulate your risk, and it is generally used if I go to the first slide, currencies. A lot of things happen in the forex markets. The rates go on and on. So when there is high import and export happening in a company, you will see the financial department or the finance manager or everybody trying to do a lot of hedging through derivatives. If I'm afraid of the USD depreciate, the INR appreciating or the INR depreciating against the USD, I will take accordingly a corresponding options on that particular currency, depending on the nature of transaction. If it is an import, there will be a different kind of instrument that will follow. If it's an export, you maybe try to go into another. So if you're importing, for example, if you're importing, you are afraid of what? If let's say, for example, today the INR plus US one one USD is equivalent to 85 INR, and after 1 month, maybe the INR depreciates and one USD becomes 90 INR. So now if you are importing goods at 2000 USD, if you would have to pay 1,70,000 right now, you would have to pay 1,80,000 after 1 month. So you as an importer are afraid of INR depreciating against USD. That is exactly why. So you're afraid of INR depreciating. So you would buy a put option on that particular currency so that you can insulate that risk. So as and when you buy, your transaction will happen at that loss only. But if you're buying the put option, then the gain that you will gain out of that particular option buying will insulate for that particular risk. So currency hedging is a different science altogether and different subject matter. But just to keep the discussion more straightforward, we discussed the holistic idea behind derivatives, and I hope I was able to explain it properly to you guys. And in case of any queries, please feel free to reach out to me. You can drop in your concerns on the comments, and if you want me to discuss on any aspect in a more detailed way, then do let me know in the comment section. So thank you for sticking till the very end of the video, and I hope it was insightful and helpful for you. Thank you so much.